One calculation we business owners must know and must understand the genesis of the calculation is the personal wealth gap. What does that mean? Well, in short, the wealth gap is the shortage of wealth we have between where we are and where we desire to be. I want you to put in your mind's eye a river. So I live on the Tennessee River here in East Tennessee. Where I live in the bend of the river, it's maybe just about 3/4 of a mile, maybe about a mile across in width. It's a pretty wide area of the river where I'm located. And many times during the summer times, me and the boys or me and the family will go down. If we're not taking the boat out, we'll take a four-wheeler down to the riverbank and we'll throw some inner tubes in there and just go floating in the river and enjoying the coolness of the water. In the wintertime, we'll go down, we'll look for trinkets which have washed ashore. But if I had a desire to go from this side of the river, whichever side I'm standing on, to the opposite side of the river, I need to figure out how to traverse it. I need to figure out how to cross that river. That's a gap. With that vision or that mental picture as a backdrop, I want you to think about wealth in this scenario. Where are you at today in your wealth? And ultimately, where do you need to be to accomplish your goal? You say, well, Justin, I don't think that way. Yes, you see, what happens is, as we business owners, we get caught up in the day-to-day of our business. We drive in and we dive in and we put 130% of our effort into our business only to fast forward through a decade or two or three or four and found out that we're destitute. We cannot sell our business for what we think it's worth. We haven't prepared for ourselves. And friends, I've seen this journey. I've seen this happen many times. I've heard this song. I've seen the t-shirt for people who wear this. They're in their 60s, their 70s, and even their 80s, yes, and they're still having to work to produce their income because we don't take stock on where we're at. Now, none of us would hop in a car and go on vacation without keeping a calibration, if you will, or a checkpoint of where we're at and how much distance we've covered on our trip. It's not uncommon for me and my family to take 8, 9, 10-hour trips, and inevitably we've all heard the, "Are we there yet?" Yes, that statement from our kids, because even our children know the value of tracking our progress along a journey. When it comes to wealth gap, there is a way to calculate it. And just like me standing on the riverbank looking across the other side, trying to figure out how I'm going to get there, or just like us taking a journey across country or visit the family down in South Georgia, we have a starting point. And so let's look there to begin with. If you're going to figure out your particular wealth gap, you need to know where you're at today. Well, what does that mean? Well, you need to take an assessment or take inventory or take stock of your current income producing assets without including your business. What? Yeah, so here's what I want you to think about. I want you to think about the investments that you have in your retirement accounts, in your bank accounts. Maybe you have income producing property like real estate. Maybe you have dividends that are coming from other companies to which you own. What is that total? What is that total? That's the first step I have for you. Is look at your net worth statement and look at the assets that you have. Well, what should not be included in that? Well, don't include your business and don't include your house. What? Yeah, don't include your business and don't include your house. See, I don't view your house as an asset. It doesn't produce income. I'm in alignment with both Dave Ramsey and Robert Kiyosaki on that. I don't view the dwelling to which we live in as an asset that's going to help us in retirement or in an income producing scenario. Yes, sure, you can sell your house and take cash out of it, and you can downsize, and maybe you find yourself in that position, but inevitably, you're going to have somewhere to live, and whether or not it's paid for or you're renting, you're going to have some sort of a cost involved in that. So I like to not include our business or our house. Well, Justin, you explained the house. What about the business? Well, statistically, only about 12% of businesses, 13%, 14%, depending on which market your business is in, is actually going to transact or is actually going to sell. That's statistically. Well, Justin, my business is above average. Yes, yours and so everybody else is out there. I read a study not too long ago where people were being interviewed about their driving capabilities, and the majority of people viewed themselves as above average drivers. Now, that's not possible. Everybody can't be above average. We just are average. Yeah, I'm sure there's individuals out there who are above average drivers. Think about those professional race cars, or maybe stock car drivers or something of that nature, or maybe military who's been trained, police. They are been trained on tactical driving skills or above average drivers, but many of us are not. And so in that same light, most of our businesses, candidly, are not positioned for sale. So we have a gap. We know where we're at as far as assets are today. We know how much money we have in our banks. We know how much our rental property is worth. We know how much our investment accounts, whether it's 401ks, IRAs, Roths, whatever it is, non-qualified assets, we know how much they are worth. How much are yours worth? Take a pause here, think through it, write down what your assets are currently worth. Now, part two of that is, I want you to look at your income producing assets. Maybe you have rental houses providing you income. Maybe you are looking at your Social Security statement. I get mine about every 3 years, I think it is, and I look at it and say, oh my goodness, $2,000, $4,000, whatever the number ends up being, it's not going to provide a lot of income for me and Miss Emily. What is your income producing assets at this point? So for kicks and giggles of today's conversation, let's make the assumption that we have $1 million. And it's providing us roughly $40,000 a year in income. Now, that's a rule of 4%. We spoke about this on the podcast. Mr. Chris Stewart and I just spoke through this not too long ago. You're welcome to go back and listen to it, called the rule of 4, or the 4% rule. So basically, if you have $1 million in assets, it can roughly provide you 4% without really affecting the principal or the corpus of the value. So let's assume we have $1 million and it's providing us $40,000 a year. Okay, we know this side of the river to which we're standing. We know our starting point on this journey. Where are we going? That's the other side of the equation. We have to know where we're headed. Now, here's where it gets complicated for you and I as business owners. I have yet to meet a business owner that does not often live through and in their business. What do you mean, Justin? Well, many times we have expenses that we legally can utilize through the business that, candidly, if we didn't have the business there, it would come out of our lifestyle. Maybe you have a cell phone that you're using for the business. I do. My cell phone is nonstop business usage. But if I were not in business, does that mean I'm not going to have a cell phone? Well, after this many years, it's kind of glued to us, isn't it? I have clients who have vehicles through their business. They use their vehicle for 100% of the business use. Well, are they going to go down to a one car? Like maybe their spouse doesn't have a business use vehicle. Are they going to go to one car during retirement? No, more than likely not. They're not going to change their lifestyle that much, which means that now they're going to have vehicle usage that they have to cover out of lifestyle. So for you and I as business owners, if we're not careful, we really won't estimate the true cost of it, of our lifestyle. There's a calculation that we're going to cover in detail in our next episode called normalization of the income statement. Some people call it normalization of the profit and loss statement. I'm going to teach you how to do that next episode. But today, for simple kicks and giggles, let's assume that we're living through our business a little bit and that we spend roughly $150,000 a year in lifestyle, including what we live through our business and raising the family and all this other stuff. We've looked at our budget and we know that we're going to need $150,000 a year in order for us to live. Well, that's $12,500 a month. You're like, Justin, man, I don't think I can make it on that. Well, figure out what your number is and apply the same concept to your number. If you say, Justin, my goodness, I don't need $12,500 a month. I need $7,000 a month. Whatever your number is, use this as a calculation template, and we'll place this on the blog, a little calculator there that you can, or calculation formula that you can use to calculate your own numbers. Now, here's where it gets the second part of this, is if I'm utilizing $150,000 a year for my lifestyle, I'm assuming that is after taxes. Now, taxes is one of those wild cards. We speak about it often on the podcast and in the blog because we don't know what Congress is going to do. In fact, just this very day, as I'm recording this, had a client in the office that was asking me questions about the future effective tax rate. And we actually went and looked historically at what the tax brackets have been and how his taxes would be affected if we went back in time using historic tax rates. Now, I don't know where we're going to be in a few years. I have to believe that we're going to see an increase in taxes. Social Security is underfunded. With the printing of the dollars and the national debt, I just don't see us staying at the current tax rates for an indefinite period of time. I firmly believe we're going to see an increase in taxes. But let's assume we need 150. And for kicks and giggles, let's say that our gross number needs to be $190,000. Are you with me? We know where we need to be. We need to have $190,000 a year coming from our assets in order to provide us the income we desire. So what is our wealth gap? Before I dive into it and before I explain this, let's have a word from today's sponsors.
If we had learned anything from recent events, it would be the importance of having a personal financial plan to weather any crisis life throws at us. Heritage Investors helps small business owners to reach their financial goals with holistic wealth management services. Learn how by visiting heritageinvestor.com today.
So we're studying this idea of a wealth gap. We're studying the wealth gap. And as we dive into this idea of a wealth gap, we have to understand where we're going. We've already spoken about that we're on this side of the river and we know exactly where we are today. In our illustration, we have $1 million in assets providing us $40,000 a year in income. And we know that when we reach the other side of this journey, this trip, we need roughly $190,000 a year pre-taxes in order to provide us $150,000 a year post-taxes for the rest of our life. So how much do we need in wealth gap? Well, if we currently have $1 million that's providing us 4%, then we need an additional $3.8 million. You see, we need roughly $4.8 million, giving us a 4% distribution rate to provide us roughly $190,000. And it actually ends up being $192,000. $4.8 million. And at this point, you're like, dude, you're saying I've got $1 million and I've got to come up with $3.8 million more in order for me to sustain my lifestyle? Yeah, that's what I'm saying. That's exactly what I'm saying. Therefore, your wealth gap is $3.8 million. Well, Justin, I thought you were going to encourage me, man. I didn't think you were going to make me depressed. You see, this is one of those numbers that we can calculate to show our progress along this business journey that we're on. If I'm on one side of the river and I'm looking across, I'm trying to get to the other side, wherever the other side is for you. Some people say retirement. Some people say, I want to grow a business to a certain point. Some people say, hey, I want to transition a business away to my key employees. Whatever your decision, maybe you want to move it to your children, whatever that time frame is, there will be a point in your life, more than likely, to where this business that we're currently living, the lifestyle we're living is not going to be there. We won't be living through it. Therefore, we have to come up with the dollars ourselves. Well, hang on, Justin. I don't think you're calculating this number right. What about the income? What about Social Security? Okay, you bring up a valid question. So I was trying to keep it super simple. Let's dive down a little bit. Let's peel the onion back a little bit and let's dive a little bit deeper into our theory, our philosophy of wealth gap. So just to lay the stage, we have $1 million in assets today. Maybe it's a rental property, maybe it's a portfolio, maybe it's something that's providing us $40,000 a year in income. We know we need an additional $3.8 million more in order to get $190,000 a year in income. But let's make the assumption that Social Security is going to be there for us. Let's make that assumption. And for this illustration, let's make the assumption, just to keep it simple, that Social Security is going to provide you and your family $40,000 a year. Okay, we have $40,000 a year coming in from Social Security. We have an estimated $40,000 coming in from our current assets. That means now we only need $2.8 million more, earning 4%, to bring us that $190,000. Okay, Justin, you just dropped us from 3.8 down to 2.8. That's $1 million difference. Yeah, Social Security is pretty valuable in this illustration. Now, maybe your illustration numbers are not the same as what I'm illustrating here. Maybe Social Security for you is only going to be $36,000 a year. Maybe it's only going to be $28,000 a year. Maybe your number will be a little higher. I don't know where your particular number is, but Social Security plays a major part for so many people. And we've been paying taxes into the system for years, and we want to see that come back to us. So Social Security plays a big part. And at this point, you're maybe saying, yeah, Justin, but we're still $2.8 million. Okay, let's add some gravity to this. Let's make the assumption you're 45 years of age. And you're like, dude, I love it. I can make $2.8 million in the next 15 years. I want to retire at age 60. Okay, that's not uncommon. I've got $1 million today. I want to retire at age 60. How in the world am I going to make an extra $2.8 million to cover this wealth gap? You see, this is where I often say that Wall Street is not a friend to the business owners, because if we were going to try to save our way to retirement, if we were going to try to save our way and span this $2.8 million chasm that we find ourselves in, if we're looking across that river picture that I showed you earlier, we have 2.8 million strokes to necessarily take to get from one side to the other. It would require us $8,833 per month in saving with a 7% constant return for the next 15 years for us to reach our goal. Holy cow, let that sink in for a second. Let that sink in. In order for you to replace a $195,000 lifestyle that you're accustomed to living out of the business, you have to have roughly $4.8 million. You currently have $1 million. Social Security is going to bring it roughly down another $1 million. It means you have to have $2.8 million additional in assets producing income for you. Are you depressed yet? This is why I often say, and if you've heard me for any length of time whatsoever, you've often heard me say that our business is the horse we're going to ride to retirement. Our business is the number one asset that we should focus on. Now, there's a caveat to that. If you're not building your business where you can transfer it for value, and every single day of your life, you're not waking up saying, how am I going to make my business more profitable, more transferable tomorrow than today? You will find yourself a statistic, as so many will. And you will find yourself working in that business in your late 60s, early 70s, and perhaps your 80s. You will find that. Because, friends, $2.8 million for the illustration that I'm giving, $8,833 per month is not attainable for this type of lifestyle that I'm describing. Now, maybe you're used to making $700,000 a year. Yeah, in that case, it would be $8,833. Piece of cake if you're used to making $700,000, $800,000. But chances are your numbers, your lifestyle, the journey you want to see yourself whenever you cross the river, whenever you reach your destination, is probably not a significant decrease. So no matter where your numbers are today, if you look at it in the purest mathematical sense, we often feel hopeless. This is why I preach and I harp. I dealt with this in season 2, where we spoke about the value of our business. We have to dive into the value of our business and make it where it's a transferable asset. Justin, are you saying I should never invest in investments? Absolutely not. That is not what I've said, nor will I ever say that. Because it provides us the best opportunity to divest or diversify ourselves away from our concentrated position of our business. You see, a prudent business person is trying to build up assets outside of their business. Well, I'm going to go out and buy real estate. Be careful. I'm not saying it's not a bad move, but I start seeing a concentrated risk. I'm going to go out and buy stocks. I'm going to buy gold. I'm going to pick whatever your name is for that particular thing. Ultimately, here's what matters. You're here on one side of the river and you can identify your wealth. And if you can get a clear picture of where you're trying to get to, then you can identify the gap that you have within your wealth, the wealth gap. So over the next few episodes, I'm going to dive a little deeper into the specific calculations in wealth gap. We're going to look at normalization of your financial statements. Actually, how much money do you spend through your business? I'm going to give you the most common expenses that we see in business. We're going to talk about how inflation will rock your world with what we just described today in this illustration. We're going to talk about time value of money. So many business owners, man, even my own family don't get this. They go out and they spend every dime they have on lifestyle. And they're like, well, we're going to save at a later date. And my own family members who own businesses don't get this. They don't get the sheer magnitude of compounding interest. All is built into this one calculation called the wealth gap. So as we look at this calculation, the wealth gap, we've just painted the roof of the house, so to speak. Now it's time to put the walls which support the number. And if we can understand what holds up this calculation, then our fears are often subsided. You see, fears many times stem from ignorance. And ignorance is not a bad word. It means we don't know. We're in the knowledge generation right now. Knowledge is at our fingertip. But yet, candidly, friends, you and I as business owners, we just don't take the time. We don't take the time to learn. So this season, we're going to dive deep into multiple calculations like the wealth gap, and I'm going to do my best. I'm going to do my dead level best to try to convince you to calculate these particular calculations for yourself on a consistent basis. This is a calculation I do for my family monthly. Monthly. You say, Justin, I don't have time. Then hire somebody. Our team here at Heritage Business Advisors, one of the companies to which I own, they can help you with this. This is what they do. They drive business owners to reach their goal. They help them increase the value of their company. Reach out to us. If you want to learn more about it, check out financiallysimple.com. Work with me, and one member of our team will reach out to you and be able to help you. Hey, look, until next time, I realize life is hard. I get it. Life is hard, and life can be frustrating sometimes, but money doesn't have to be. Does not have to be depressing. Let's continue to make our lives at least financially simple. Hey, y'all go out and make it a great day. This tip is for informational purposes only. Please speak with a competent financial advisor regarding your specific needs. Justin Goodbread is a registered investment advisor with Heritage Investors. Visit heritageinvestor.com, financiallysimple.com for additional information.